ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Pramod Gubbi, co-founder at Marcellus Investment, joining in. Welcome to the show, Pramod, and always a pleasure to speak to you and get insights from you. Pramod, let's first start with the very key aspect that we've seen right now in terms of where the US inflation numbers are concerned, basis which a lot will be dependent on what the Fed does and in turn an impact coming to emerging markets. What's your read?
Well, there's just too many moving parts, honestly. With our style of investing, we don't pay much heed to macro, really, or what happens in the markets from a short-term perspective. We tend to focus on buying businesses which are fundamentally good and have survived multiple such adversities from a macro perspective. And therefore, in effect, we are prepared for the worst. But having said that, I think based on the little that we read and we understand from speaking to people who are in the know of the situation, or at least have a reasonable sense of what's likely to happen. I don't think there's anybody out there who's clearly, because a lot of the things are unprecedented, right? The sort of monetary policy that we've seen over the last 15 years since the global financial crisis, the sort of quantitative easing, the sort of expansion of central bank balance sheets have all been unprecedented. In fact, there's been a term coined called modern monetary theory for what's happening. So this is all in theory. How this will unwind and what will be the impact is beyond most people's guess. But if you look at what's realistic to happen, so what caused the situation on the inflation in the first place? First was the pandemic, which created supply chain bottlenecks, and then the war, which further created additional supply side bottlenecks, and finally the zero COVID policy of the Chinese government, which is also affecting the supply side situation. On top of that, the US government went ahead and issued the most unprecedented size in terms of stimulus, both monetary and more importantly, fiscal stimulus. So you sort of engineered a situation where demand skyrocketed and supply issues cropped up. And that gap between the demand and supply is causing the inflation. It's as simple as that to understand. Now, what the Fed is trying to do is bridge that gap. The Fed cannot do anything that will increase the supply overnight. It's beyond their control. Now, of course, at the margin, some of these supply concerns are abating, right? COVID is behind us. So many of the factories, many of the supply chains are slowly coming back. There have been pacts such as Russia allowing Ukrainian wheat to travel across the world, which was stopped for a good 3-4 months, which means that there's been some sort of respite to the food inflation aspect. China is crawling back. I wouldn't say there are large parts of China still under complete lockdown. So that effect is not as bad as what it was during April and May, but coming back. So supply side is coming back, but it won't be enough to bridge the gap entirely. So the only way Fed can sort of reduce the gap to zero and bring down inflation is to kill demand. So effectively, they are trying to engineer a recession here. The fact that inflation numbers came in higher than expected means that the market's expectations have to be recalibrated. What the market thought that maybe a couple more instances of 50 to 75 bips hikes would be enough to bring that demand down to the supply levels. Now, with this persistent inflation, the market is saying perhaps you'll need more than just a couple of 50 to 75 bips hikes. Now, that again is beyond anybody's guess. If it was so easy that you can calibrate so finely, you wouldn't have erred on the upside either. The Fed and the US government would have thought that maybe we don't need $1.9 trillion of stimulus to stimulate the economy. So it is a little bit of a wait and watch. I think this month's hike is given, whether it's 50 or 75 bips is just a matter of specifics here. I think that's pretty much factored into the market. And then the next one is in November, before people go over to holidays, where, I wouldn't be surprised if there's another 50 to 75. But then, some of these effects do take time. You've already raised rates by almost 200 basis points. For them to take effect on demand cooling down will have a lag. So it might be prudent on the Fed's behalf to even wait and watch to see over the next 2-3 months, will inflation actually come down based on the hikes that we've already taken, rather than try and shock the market with a couple of other hikes. So to that extent, I think we will remain in this area of uncertainty at least for the next 3 to 4 months. But the bigger sources of uncertainty, we have the Chinese elections coming up next month. We've had the US midterm elections coming up in November. So my sense is, from a market perspective, globally, you may not see any sort of moves so much. I mean, with the caveat that our ability to predict market movements in the short term is pretty much, next to nothing. But if you look at these factors and these factors at play, that's how my sense is. That's how I'm reading the market.
Right. So Pramod, overall, if you have to look at India, do you think from an economy perspective, from a fund flow perspective, we are pretty much in a sweet spot now if you have to compare ourselves to other emerging markets? Because now, in the last 1 month, you have the FIs who have turned positive as well.
Yeah, so I think you're right. I don't think we can say that India is completely immune, or what these days they're using the word decoupled. I don't think you can go to that extreme. I would say that yes, relative to other parts of the world, particularly relative to some of the other large economies in the world, we do come across as a bright spot, and rightly so, because we did go through our own adjustment period, right? So over the last 8 years, there's been a long period of cleanup of the economy that's happened, whether it's the fixing of the banking system under Dr. Raghuram Rajan's tenure as the RBI governor, which forced banks to recognize those NPAs, which meant that banks' capital was depleted, and therefore there was no credit available in the system to fund economic growth. Furthermore, you had demonetization and GST, arguably both of them intended at long-term positive decisions, but there were short-term disruptions, particularly in the SME sector and so on. But now both these factors have come around and are showing that they are long-term positive. The banking system is perhaps at its, what do you call it? It's the pinkest of health, right? So the capital adequacy ratio around 17%, at least I haven't seen these sort of numbers in my career. So we've got a very strong banking system. Secondly, GST is playing out in how the tax to GDP ratio is at its highest levels ever, both direct and indirect taxes. The corporate tax rate cut off 2019 September, when it cut from 35 to 25, is also increasing tax compliance. So that's actually sort of cushioning the impact of high energy prices on our fiscal deficit. Similarly, look at financialization of household savings, right? We've finally given up our love on real estate and gold, and Indian households are parking more and more money into financial assets. Look at the way the mutual fund industry has grown, or insurance has grown, or PMS has grown. Even bank deposit growth has been fairly healthy, to the extent that you can see, despite interest rates going up globally, Indian home loan rates, for example, are pretty much at the same level as the Indian 10-year treasury bond, right? So both of them are at 7%, whereas in the US, the 10-year treasury is at around 2.5–3%, but the mortgage rate is around 5.5%. So obviously, this low cost of capital does have a positive impact on corporates and businesses being able to borrow at low cost and fund future growth. Similarly, consumers like you and me can buy houses with pretty low home loan rates. Again, this is extremely unprecedented. And finally, I think full credit to India is the digitization, both on public goods as well as private goods. The cost of welfare has come down because of leakage coming down through direct benefit transfer, thanks to Aadhaar. UPI has made significant productivity gains in the system, being the highest peer-to-peer money transfer mechanism. And there are plenty more in the anvil with ONDC and account aggregators, which will digitize Indian public goods. And the same digitization is also benefiting private enterprises. Companies have managed to crush their working capital cycle, release a lot of free cash flows, increase the returns on capital using technology. All these are adding up to India showing in brighter light. And finally, no credit to us, the fact that China is going through its weakest time. Part of it is intended. They're trying to re-engineer the economy towards more consumption and services as opposed to more manufacturing and exports. They're trying to deal with a broken financial system with the property market. And the geopolitical issues in Russia and China means that the West is looking at India as a credible alternative to China in terms of a large economy where they can invest. So add all of these factors together, I wouldn't be surprised if money continues to pour into India. Both you talk about FPIs will come, but I think FDI as well. India
Right.
will become a number two manufacturing destination, even if a small percentage of China's share of manufacturing moves to India. It'll be a big flow, a gush of money coming into India. So relative to everything that's happening in the world, I think we're in good shape. But if the world goes through recession, our exports will also take a hit. If global interest rates go through the roof, we'll also have to hike. If inflation remains entrenched, particularly around energy prices, we'll also take a hit. But relatively speaking, I think we are in better shape.
Right. So Pramod, taking it from here, clearly, from what you've said, banking, yes, in a sweet spot. The rally is not yet over, and lots more to watch out for, from the banking space as a whole. But the other aspect that you mentioned right now is with regards to becoming a good spot in terms of a manufacturing hub. Do you think the strategy should be now to start investing from a domestic market perspective, concentrate on companies which are domestic focused, and slowly, steadily over the long term move to export oriented companies, taking into consideration with the caveat that there are no recessionary fears around and everything is kosher?
Well, I mean, so far what I talked about was more from the economy perspective, right? How do we stack up as an economy? Why we need to boost the manufacturing side of things, and also how the world is giving you this opportunity. Now, historically, the economy and markets can be, I mean, to use the word decoupled, right? China went through one of the strongest economic growth periods between 1990 and 2020, and the returns from the stock market have been next to nothing, right? So stock market returns doesn't necessarily have to correlate with the economic fortune. So we'll leave the linkage aside. From an investment perspective, should you invest in domestic focused economies? Absolutely, yes. India is a domestic market. It is 140 crore people in terms of population. It's a massive consumption market. That's always been the story. India, beyond IT and pharmaceuticals and maybe a little bit in terms of chemicals, has barely had any export stories to talk about. So it's always been a domestic market. I think that will continue to be the structural story for India from an investment perspective. Of course, at the margin, there will be emerging opportunities in terms of servicing global demand. Like I said, in the short run, it's difficult given that there is recessionary fears in the world. But if you're willing to take a longer term view, I think there could be opportunities coming in as some of the manufacturing shifts from China to India. It's already happening in sectors such as specialty chemicals or APIs and pharma, for example. Those are readily available opportunities one can play. But otherwise, for true industrial manufacturing to become an export-oriented story, it is a few years away from now.
Right. And overall, especially, what would your view be if you have to look at a particular sector from a consumer discretionary and a real estate perspective? Do you think these are sectors to bet big on?
Consumer discretionary naturally will be a structural story for India, because as the per capita GDP of any economy goes up, people tend to have covered most of their basic needs or staple needs for that matter, and start spending on discretionary items. So that's going to be the next leg of the journey for the Indian population, and hence an opportunity for investors. Real estate as well, housing is a basic need at the end of the day. Eventually, the aim of any economy is to provide housing to all its population. So that'll be a structural driver. However, to play housing, you don't necessarily have to buy into real estate developers, given the asset heavy nature of that business. And we've seen historically that can be a little bit of a challenge. But at least from our investment philosophy standpoint, we would rather play real estate through building materials, the suppliers to the real estate industry. such as paints, adhesives, pipes, ceramics, sanitary ware, electricals, and so on and so forth, which are relatively asset light. At the same time, there are sources of brand and distribution network which work as competitive advantages, which in turn drive pricing power. And there is a large unorganized market in these industries, which gives you an opportunity to grow faster than the underlying market by taking market share from the unorganized players. So yes, in some ways, consumer discretionary and building materials for houses would be a relatively strong story for the next several years.
Right. And Pramod, overall, another aspect is considering IT and FMCG. IT, yes, again, an export-oriented sector, lot of dependence in terms of, the international markets. However, that's not something that you can avoid right now, or we can say that, yes, it's going to be a difficult or a sector where you should completely avoid. Similarly, with regards to FMCG as well. So, would it be right to say that these two are sectors where you can put your bets as safe bets, but you might not see them as growth sectors?
Well, FMCG, yes, maybe. Like I said, given our stage of evolution as an economy, given where our per capita GDP is, some of these sectors might have seen significantly high penetration already, and therefore question marks on growth. I don't think they are gone X growth, but the growth that we've seen, say in the Northeast, double-digit volume growth may not come back again. This might at best be high single-digit volume growth. So growth slowdown in FMCG across the board is I think a natural conclusion from that perspective. But having said that, there will always be opportunities in more niche FMCG companies which are catering to product areas where more than the penetration, the quantity and the frequency of usage will determine future growth as well. I would say FMCG, do not paint all of them with the same brush. You be more selective in terms of what product categories you want to sort of play in. IT, I would disagree, is gone X growth. I reckon IT is still in the prime. I just got back from the US and speaking to IT consultants there and companies there. You realize that the penetration of cloud computing is pretty low there. So if cloud computing and digitization were the growth drivers on which IT services did well as a sector over the last couple of years, just because the US is going into recession, I don't think digitization and cloud computing plans will be put to rest. Maybe there will be a brief period of slowdown. Maybe it'll go into a hiatus, but the long-term story is fairly intact. Businesses will have to digitize. There is no option. It is a source of competitive advantage. Companies will have to move their IT infrastructure from on-premises to the cloud. There is no option. There's significant efficiency gains to be had from that perspective. And Indian IT services will benefit from these two trends, not just for the next couple of years, but for the next decade or so. Like I said, the global recession fears, given the uncertainty, means that some companies, some customers of the Indian IT services industry might delay these plans, but they're not going to quash those plans. So a 15% top line growth with a little bit of sort of operating efficiencies and the currency depreciation effect would mean 20% bottom line growth for Indian IT services is reasonable to expect.
Absolutely. So clearly, from what we discussed as well, we seem to be in a much better spot right now, and probably a lot of avenues of investments that come in, which could be growth drivers. But thank you, Pramod, so much for joining us on the show. Pleasure to speak to you as always. Thank you. Stay safe and speak to you soon again.
Most welcome. Thanks for having me.
Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.